Good morning. Sun's out, it's a beautiful day. Very cold last night. Don't want to use phrases like the beast for the east in speculative times like that. I'll leave that to scaremongering newspapers. When I was a kid, one of the things I used to love about America was this program has been brought to you by Dental Floss, or whatever it was they were going to advertise on the day. This coffee has been brought to you by Cold Blow. Grant, this is just top stuff. I'm on the decaf, guys. I'm sleeping perfectly. You don't want to not sleep at times like this, otherwise you'll start thinking and acting crazy. So keep the Diet Cokes down, guys. Too much caffeine. Anyway, moving on. We won't go into that area. I thought this morning I'd talk about stock market collapses. I know it's a bit late for some of you if you wanted to really speculate on this and kick the shit out of it, but I just want to talk about the nature of stock market collapses and slumps and whatever, and see where that thinking goes. Everyone thinks of stock market crashes, say, as the sort of late 20s crash and the 30s depression, the 87 crash, the 2008 credit crunch, and this, the genuinely interesting mother of all crashes that may or may not have finished yet. Okay. Interestingly enough, there are some ones further back than that that are quite interesting. They've got some sort of interesting lessons that perhaps we could look at. And the one I think of is the South Sea bubble. That was sort of like round about 1710, say. Everyone was going mad for the idea that you could write, a company could have a right to own a whole continent full of innumerable goods, massive wealth, fields of gold, the right to sell slaves, the right to make sugar, the right to do anything. It was just like, it was an amazing thing. You know, this company gets set up and everyone starts buying into it. And interestingly enough, there are some precedents of what happened there that are pertinent now. One of was insider trading. Benefits to people in the know at the cost of people not at the know. Now, I've been in the markets for a long time, and I knew all about insider trading, who was doing it, what they were doing, how they were doing it. And it went unchecked, and it still does go unchecked in many forms, because it's politic patronage, it's back scratching, it's you do me a favour, I'll do you a favour, and whatever. It's part of human life. Back then, anyway. The scam then was Jon Blunk, who was the guy who ran this. He would get to a load of politicians, and then he would give them some shares. He wouldn't sell them, he'd give them to them, and then he'd ask them to do something or say something, and when the market went up, they could sell them, thank you very much, and they just keep all the profit. Okay, that's how you inflate a stock. Right? That's how you get something irrational to go from nil to massive inflated prices. And that's what happened to the South Sea Bubble Company. And at the height of their dizzy fame, Jon Blunk came up with this amazing scheme, right? And this is proper out there amazing. This makes your Ponzi scheme look like a con for amateurs. What he did was he went to the Bank of England and he said, I'll buy your debt and I'll write some shares instead, because everyone wants my shares, you don't want your debt. And what I'll do is I'll take over your debt, right? And instead I'll sell some shares, and instead of you paying 6% for your debt, I can fund it cheaper than you, and I'll lend you the money at 4%. So off he goes, and everyone thinks this is absolutely fucking marvellous, darlings. You know? So what's happening is he starts to underwrite the government debt, And this all goes like swimmingly well, and everyone's going, "Fuck, this man is a right proper Goliath. He really understands economics." I don't know if Adam Smith had written The Wealth of Nations by then, but it's all around about this same time, and it all goes swimmingly well for a while, and then he comes up with another idea, which is even better, because this is the way of craziness when it really gets going. One crazy idea leads to another, and it's just beautiful, this one. What he then says to his investors is this. He goes, "I'll lend you the money to buy our shares." And you think, well, that's a novel approach. But everyone went, no, there's nothing novel about that. It's very economically sound. That makes a lot of sense. The market's not really doing what we need it to do. So what he will do is he will lend us the money to buy the shares that he's selling. So that went on, and that looked good for like a few months or whatever, until it came down to the redemption date to pay the money on the interest on the money you'd lent them, so whatever. So what happens was that to meet the interest rate payments that these people had to make on specking shares, they had to actually sell the shares to pay back the loan to buy the shares. Get where this loop's coming from? I lend you some money. In 3 months' time, you'll have to pay me back some interest, and a bit of capital. And you can buy these shares with that money. So you buy the shares with the money. 3 months' time, I want some capital back and some interest back. And you haven't got any money because you've but you have got some shares. So you owe me some money. So what you do is you sell the shares to pay me the money. So what happens is I've lent you the money to buy the shares. You haven't got the money. The market goes up. You make a little bit of money, you sell the shares, you give it back, you pay me back a little bit of the debt and interest, the share price goes down. Then that's all right as long as there's not many people doing it. But the moment that starts to go like that, you've had it, because it says you've borrowed a load of money to buy a load of shares, and you haven't got any money, and your shares are worth not what you paid for them. I was going to say shit all. That happens a little bit later, but your shares aren't worth what they were worth. So this is what happens. This is how the South Sea bubble gets going. The fact that the tenet behind it, the idea that the Americas was an immeasurable, bountiful place or whatever, ironically, although at the time you could say, well, this was a stock correction because there wasn't that much income coming out of it. If you looked at it over a long run, America was a pretty good place to buy. It just wasn't a pretty good place to buy at that price with that kind of mechanism. So with that kind of mechanism, it starts to get iffy, and then all of a sudden one day, it's I think the phrase for it, and I love this phrase, it's a stock market phrase. It says, "Eats like a mouse, shits like an elephant." All of a sudden, the market's feeling a little bit iffy because everyone's got to make these interest rate repayments, and then it goes to have a little poo, and its whole entire arse falls out, and the rest is history. You've got this massive collapse, and guess what happens at the end of that massive collapse? Yes, you got it. The Bank of England come in and bail out the rich people. Yeah. Okay, we'll leave that one aside. What's interesting on that one is that wasn't actually an insider trader collapse, because the people inside the company knew that it wasn't producing the revenue that the market was expecting. That's why they sold the bonds or lent the money for people to buy the shares. So that was a collapse built around that bit of what happens when you need to pay the money back. They knew all along that it wasn't making enough money. It's not that it wouldn't eventually make enough money, it just wasn't making enough to meet the market price. And the market collapses, and you got into that credit loop thing. Remember I was trying to say yesterday about what George Soros talks about in reflexivity, and they're kind of like rolling self-feedback loops. Okay. So the similarity between what we've got now And what we had then is quite interesting because the scale of the price move is similar, but the actual logic of what's happening is very, very different, and the solutions posed are equally as, should we say, interesting, because we're in uncharted territory here, but some things we actually know. I hate, Donald Rumsfeld. Everyone thinks Donald Rumsfeld, what a great guy. He says there are known knowns, there are known unknowns, there are unknown knowns, or whatever. And you think, and he uses that to go and bomb the fuck out of a load of innocent people and devastate a whole country and totally fuck up a military strategy, and then comes back and his answer to what went wrong there, Donald, was there are things I knew, things I didn't know, and things I didn't even know I knew. So that's not an excuse for what he did. Anyway, what we're doing at the moment, it's a very popular phrase. A lot of people like defining logic in those terms. I don't define logic in those terms. I define excuses in those terms. Right, what we've got now, stock market comes down. As I said yesterday, we're in a situation which is potentially very perilous because next week people are going to be starting to ask questions that can put a split in society. You can see we're at a very, very dangerous juncture in time. The speculators have been allowed to sell short, uncorrected, despite the fact that people have known what's going on. I heard mumblings from the Bank of England on Thursday, maybe as early as Wednesday, about disorderly markets and the concept in their own mind that this can reach a point where you just have to shut it because you just can't do anything. And that has happened before, and it, like as not, might happen again in the future, or it might happen next week. So this time round, what's happening is it's not the Jon Blunk in the South Sea Bubble Company saying, I've got an idea. I'll lend you some money to buy my shares because they're so good that I will share with you the opportunity to share in unheard of wealth. And everyone goes, oh, that's so kind of the guy, so kind of him. And I think, no, that's not what was going on. But ironically, the government's coming into the market and it's kind of trying to perform this role the other way around. And it says this, we'll lend you the money to buy the shares. You remember, I don't know if you guys are watching Trump on Buybacks on Friday. Buybacks are a very interesting phenomenon where a company buys back its own shares to put its price up. The reason that works is if less people own the shares, the dividend is spread around between fewer people, therefore the share is worth more money, therefore it goes up. What's been happening in America is, as pretty much predicted, the government puts money into the system, the money is taken by the banks to fill their balance sheet, it's then taken by the companies not to reflate or ensure their businesses survive. They go in and do share buybacks with the idea that it will stop their share price going down, therefore it will go up enough for them to sell it. Okay. They own the shares, they're worried about the price of the shares, they're not worried about the company, they're worried about the capital that they have in the shares, and instead of investing in their firm or keeping the money for emergency things, they go into the market and buy the shares. Now Trump rightly says, I don't like that, I never did like that, and that's an interesting phenomenon that you no doubt will see some action on next week. But what's happening this time around is when the market's in complete chaos and decline like this, the government is now doing this sort of Jon Blunk move where it's going in and saying, we'll lend you the money to buy some shares. And this is a really intriguing concept because we apparently live in a capitalist society. We apparently live in a capitalist world. We have stock markets and central banks and governing bodies that rule the economy because we believe in a free market economy. But what we're doing is something that's totally non-free market. But we're doing it selectively. We're doing it, this bit of non-free market economics will do. That bit of non-free markets we can't do because that's sacrilegious. This bit is essential. Now, this is crazy because we're in a field where no one's been before. No one knows exactly what is going to happen here or where it's going to go. But What we do know is there are some precedents and there are some logical things that have logical consequences. Now, quantitative easing, which has been the gag of the last 10, 12, 15 years, is the government buying back its own paper. Now, paper means bonds, loans, with money that it's either printed or borrowed. So we're starting to get into a Jon Blunk here, you know, guys, because I like you, I'll lend you some money to buy these shares. And what happens when the market starts to go down? What's happened in the stock market over the last 2 weeks really has been quite logical, in that unlike any other crash, the effects are very immediate. When the South Sea bubble happened, okay, the economy went a bit, you know, to hell and back in a handbasket, but there wasn't really that much cause behind it, because eventually people go, oh, I quite like having sugar, I quite like the idea of owning fields of corn and whatever, and America was still there was still the opportunity, it corrected. What's happening now is they don't know what's out there, and that is causing a panic that, unlike then, is actually closing businesses, because it's fundamentally questioning what this business is worth. Will it survive? We're working on the idea that this will be a 3 to 4 month thing. The logic of the scientific logic of things is this: is that viruses mutate, and you would be a very brave gambler to put odds on that price being right. You would have to think, well, the possibilities are that even in 3 to 4 months, with the mutation rate that these things have, there is possibility that it could mutate to be worse, or we could not be able to contain it, or whatever. So potentially you've got a dangerous position that is in essence reflected in the price. But unlike in the stock market or in the crash with the South Sea bubble and subsequent crashes, say like the 27 or whatever, this has been an interesting one, because some people have definitively known this is going on and some people have not. And interestingly, I was trying to look back on what we thought the causes of the 87 crash were, 1987. I was in that. That was quite an interesting day on the stock exchange. That one, the futures market was mental. It's an interesting story for a night on the beer, but not for here. What happened in the 87 crash? No one really. I'm looking back. Who thinks they know why it crashed? And I think really back then, I think the most logical answer I could come up with at the time was, well, if the government were paying 8.5% on long bonds, why the fuck do you need to be in the stock market that only pays you 10%? I.e., if there is a risk with the company that you're in, and there's not a risk with the government, everyone buys the government by default. Once they've already been rewarded that much by the government for not investing, they sell the shares. So that's the most logical economic argument I can think of. But what was interesting was that was the first real crash where you could get short of shares that you don't own. Now, if you go online and jiggy about on Google, and I'm not going to put names into this because these guys used to be my customers, and I don't want to individually name people, but go and Google the people who really made money in it and see what they did. What they did was they didn't sell shares that they own, they sold shares that they didn't own. And this is the first time really that people had been able to get into the market and sell stuff that they didn't own. And they were doing it through the futures exchanges, which is why I've said the imperative need to shut the futures exchanges. Then when we get to the 2007-2008 credit crunch, is this an insider trade? Well, I'm trying to think of the guy, Blankstein, who is notably made like truckloads of dosh out of it. I don't really see that one as a particular insider trade, apart from this. Every fucking bank in the world knew that its credit rating system was completely bollocks. They had abandoned any form of credit rationale. When I started in the markets, you used to have to do very scrupulous checking of people just to lend them money overnight. And the whole banking system had got itself into a system where it thought there is no risk. We can cover all our positions by hedging everything into the futures market. Therefore, we can write paper or debt, whatever way we like, because we've covered it in the futures market. And that's why you saw this massive growth in the futures market and what are called derivatives. But what came home to roost with this one was this, that there came a point where people were lending people money to buy their own shares. And that's in essence what was going on, and Blankstein just says, oh, look at the king's clothes there, I can see his arse. And that created the slump that took however long. Wasn't that really a major catastrophe? I don't know. Is that just global reallocation? I don't know. Who knows? This one is interesting. Back then, Blankstein goes out and takes out a load of contracts and whacks the derivative market. Other people who get to know about it jump in and hit the futures market, and then all hell breaks loose. This time round, we're seeing a mega collapse, and it hasn't stopped yet. And the reason for that is we're in an irrational fear moment rather than a what is the underlying issue here. The irrational fear market takes the market down 30-40%, and then it starts to, as I say, evaluate what it thinks the situation is, which is what we're at the moment. Can this be contained at these levels? At the moment, the containment strategy is I'll lend you some money to buy those shares. And that is fundamentally the containment strategy. And because the government doesn't have the money, what the government is saying is I will print the money to lend you the money to buy those shares. And which is the most illogical, free market approach to what would happen. If you were to say, I believe in a free market, what you would do is you wouldn't do any of this. You would just let it run and see what happens. Okay, they say, well, you can't do that because that will mean the banks will go and everything will flop and whatever. Okay, so we say, okay, so there are logical, moral and philosophical areas where we will intervene in the market for everyone's good. So we don't have a model that says the free market is this and it must be able to do this, that and that unchecked, unless it perhaps at the time suits the individual speculator or investor to advocate that kind of action. We say when the shit hits the fan and I'm likely to lose any money, we need to change the free market model. Okay, so the free market model is only an invent in our heads. It's just something that we currently allow to happen. Where am I going with this? God. When the government is in the market borrowing money to lend to people to buy their shares, which in essence is what we're in, what they're doing is they're kind of underwriting the credit value of these companies, and they say, we're doing that because our value is absolute. To understand that, it's if you own a pound note or whatever and it says, I promise to pay the bearer or whatever, the guarantee is from the government, and they say, well, the government can always decide what something's worth. We can always print more money. Now that doesn't work. Historically it doesn't work, because what happens is once you start getting into printing money, you get into other forms of collapse, and those are collapse in the faith in the money, which is what we're watching the markets do at the moment. Which is why government borrowing costs are going up, stock market's coming down. Remember that 87 crash and the stock market government borrowing prices going up, eventually the stocks have to come down. Well, you end up in the same thing. At the moment, the government's coming into the market and saying we'll underwrite it, therefore the cost of government borrowing is going up. The more the cost of borrowing goes up, the less incentive there is to hold shares. So if your stock market is here, right, and it's come down from there to there, and you say, right, what we'll do is we'll guarantee to lend them money to buy their own shares, what happens is the cost of government borrowing goes up, like that. And as that goes up, the rationale and reason to hold shares goes down, because you are guaranteed a return over here from the government that you cannot get from the company. So what happens is, down goes the market like that. The government comes into the market and starts to borrow and write money in order to lend people to buy shares, and the market goes like that. Okay, I hope that makes sense. Stock market collapses because there's a known fear. This fuck off known fear, Rumsfeld, you wanker. Right, comes down, and it settles where we are now, and the government says, right, we'll come in and underwrite the debt, and the more the government underwrites, the more the debt goes down, because the investor says, I'm not going to invest in the company once I've got a chance of getting that much over here. So the government, I said earlier, yesterday, about the markets could quite easily say, well, the risk premium for lending money to a government that starts, like our government, starts in massive debt. It starts in negative territory. GDP, bad. Balance of payments, bad. Paying out money to people who don't work, people who can't work, bad. So it starts in an already bad position. It then goes, well, what we'll do is we'll start intervening, and the markets go, well, that's all right, thank you very much, but you were borrowing last week at 0.3% and paying us no money, but in August or September we'd much rather that you paid us 9%, because you actually are more risky. You were bad then, but you're more risky then. Okay, so stock market goes down, government comes in, pays bonds, cost of government borrowing goes up. When you don't be confused here, because this is, if you don't know anything about markets, when the cost of borrowing goes up, the cost of the price of bonds goes down. So you end up with both markets perilously in trouble. At the same time as the commodity market in essentials is going up, because speculators are allowed to corner markets and drive it up in a time of emergency. So, in this crash, which could well not have happened yet, we have prices down, the government coming in to lend money to people to buy their own shares. Okay, so that's why I say you need to stop the stock market coming down. So the only way to do that is you shut the stock market. You need to stop the futures market in both bonds and stocks and commodities aggregating the situation. So you don't need to allow hedge fund managers to sell shares that they don't own. When you look at this 6 weeks down the line, you'll see who's made the money. Where has the money gone? It would have gone to the aggressive shorts. Now, in this collapse, unlike every other collapse, this is going to be the first collapse where insider trading really has had an impact. Because I'm watching what the White House keep coming out with, and we get little announcements here. I was watching this thing about in February, the government had opened 19 veterans hospitals in order to be ready for something that they weren't telling people. Now, if you just can't tell me that if the government are in society spending money ahead of this dangerous calamity, that people inside those organisations haven't been on the phone and spoken to hedge fund managers and said, look guys, look, this is happening. We've had to open 19 emergency centres for veterans because we think that this coronavirus. What coronavirus is it? This corona. Oh, what's the coronavirus? Well, it's this, that, and the other. We're doing this, that, and the other. If you can't imagine that that's going on, you must be dead or something, because that would have been going on. And that means, when I said yesterday this thing about who's going to ask that question, who's been insider trading this, I don't really want to put. I could almost write down the questions that are going to come up next week about the integrity of the process here. Who knows what? Who did what? Because this is the first time you've actually really had a chance to insider trade a market properly fucking big time. Properly big time. If you sold the 87 crash, you had to have a bit of balls about you. But once you got one or two or three or 4, hedge fund managers operating in concert, which they regularly do and did, you've got enough backing to have a good bet and see how much damage you can cause and have a laugh doing it. In this one, you are at the end of a very long bull market, and you've actually got a real cause, and you have got insider information about that real cause ahead of everyone else. So you can sell the living fuck out of it with impunity, right? Because you have insider information. Now, how far that spreads through the markets, well, the markets will just be riddled with that, but how far it spreads through the government will be riddled with it. Where do those questions stop when people start asking them? I don't know. If you can't get a president to show you his tax accounts, can you get him to give you an honest answer about what's going on here? I'm not speculating either way on this. It's just that question will be asked, and when it's asked, it's a self-fulfilling "have you stopped beating your wife" question. There is no answer. Have you stopped beating your wife yet? There's no answer you can give. If you say yes, well, why were you beating her? Or no, well, why don't you? It's a spiral question. So I'll go back to what needs to be done, because I am not in this to move this around. I just want us to see us take action that stops people who are logically going to speculate in this way and are going to make the situation far worse. Shut the stock exchange. Shut the futures market. Shut the commodity market for the period of the emergency. Okay. My decaf coffee from Grant is very good. I think he's going online, guys, so you don't have to sit there at home in abject fear and terror, not being able to drink good coffee. I'm off now. Ciao for now.